Break-even analysis is a financial calculation that determines the point at which a business's revenues equal its costs, meaning no profit and no loss. It helps businesses understand how much they need to sell to cover expenses and start making a profit. What is the break-even point? The break-even point, BEP, is the level of sales where total revenue equals total costs. At this point, a business is not losing money, but it's also not making a profit yet. Formula: break-even point, in units, equals fixed costs divided by selling price per unit, variable cost per unit. Example: a company has $10,000 in fixed costs, sells a product for $50 per unit, and has $30 in variable costs per unit. Break-even point equals $10,000 divided by 50 to $30 equals 500 units. This means the company must sell 500 units just to cover costs. Components of break-even analysis: fixed costs, expenses that do not change with sales volume, e.g. rent, salaries, insurance. Variable costs, costs that fluctuate with production, e.g. raw materials, labor, packaging. Selling price per unit, the amount a business charges per product or service. Total revenue, the total money earned from selling products or services. Why is break-even analysis important? Helps set sales targets. Businesses know exactly how much they must sell to cover costs. Assists in pricing decisions. Helps determine if the selling price is high enough to make a profit. Identifies cost structures. Shows the impact of fixed and variable costs on profitability. Reduces financial risk. Helps businesses avoid losses by setting realistic goals. Example of break-even analysis in action. A coffee shop owner wants to know how many cups of coffee they must sell to cover their costs. If their monthly rent, salaries, and utilities total $5,000, each cup sells for $5, and the variable cost per cup, coffee, milk, sugar, is $2, the break-even point is $5,000 divided by 5 to $2 equals 1,667 cups per month. If the shop sells more than 1,667 cups, it starts making a profit. How to lower the break-even point: increase selling price. Raising prices improves margins and reduces the number of sales needed to break even. Reduce fixed costs. Cutting rent, salaries, or overhead expenses lowers the break-even threshold. Reduce variable costs. Finding cheaper suppliers or improving efficiency increases profit per unit. Quick recap. What is break-even analysis? A calculation to determine the sales volume needed to cover costs. Why is it important? It helps businesses set pricing, manage costs, and plan sales goals. How is it calculated? Fixed costs divided by price per unit minus variable cost per unit. Break-even analysis is a powerful tool for businesses to make smart financial decisions, price products effectively, and ensure long-term profitability.